Welcome to the Real Estate Investing Academy, your number one source for all things real estate investing and personal finance. With your host, Tom Staub. Welcome, everyone. This is podcast number 6. Looking forward to kicking off another one today. Today's topic is an interesting one. Ray Dalio came out with a number of videos as of late. And if you don't know Ray Dalio, he's arguably the world's most successful hedge fund manager, managing, I think now $168 billion is the actual number. He had been managing around $180 billion, and the market has taken a tank in some of his asset portfolio known as the Alpha Fund, reducing what he manages. But in general, he's known as kind of the guru of how to monitor the economy, global economy, and just generally portfolio strategy as it is. And so, again, a number of videos he's come out with recently. One that he came out with was, where he sees, the big hole of COVID, right? And he says, well, basically, there's a lot of ways to look at how this is impacting the globe. And ultimately, COVID is not necessarily, let me take a step back. The stimulus package is not necessarily increasing creativity, increasing innovation, increasing GDP. What it's basically doing is saying, look, if you look at the world as an income statement, what you make versus what you spend, the what you make part, there's a hole there. And the stimulus is just filling in that hole. So it's not necessarily saying that you're creating additional revenue or you're creating additional means from additional revenue. It's just filling the gap of the current hole in that revenue. And he says today, I think today we're now, $4 trillion in the United States with the new stimulus. So he says the U.S., he sees this COVID in creating around a $5 to $6 trillion hole just on our revenue piece. Globally, he sees it as around $20 trillion as a whole. So what that means is that the U.S. has to fill in that hole of $5 to $6 trillion. And I think from the recent report of the Fed with Powell, that is definitely going to be something that happens. They're not going to let this economy implode. They're going to keep pumping the money, keep printing the money. So look for more of that. Globally, nations are becoming kind of in the same mantra of adding more stimulus, adding more money to the economy, increasing money supply, printing money more or less. And so that's interesting too. A fact that's considerably important, 70% of all transactions, monetarily speaking, that happen in the world use the US dollar. So the value of the currency of the US dollar has substantial impact to the global economy, right? And what's interesting, and I'm a huge Ray Dalio fan, and I watch a lot of his material, and one thing that you'll hear me talk about, whether it be in a previous episode or upcoming episodes, is how I distribute my capital across my portfolio, right? A lot of people put all their money in the market. A lot of people put all their money in real estate. What I've said is that you need to diversify it across asset class type. And even within that asset class type, the type of products that you're investing in. Ray Dalio goes on to talk about, well, not only do you have to do that, but now it's more important than ever to be diversifying across different currencies, different countries, different industries, the whole nine. So the key word across these uncertain times is diversification of your investment, right? Now, what's interesting is when you think about what's happening, and this is more what I want to talk about today, is that when you think about what's happening, right? It's not uncommon. We've seen that, well, it's uncommon, but we've seen this in history in 33, 71, 2012, in terms of the monetary policy that they're using to save us from the ship falling over, right? Or capsizing, if you will. And what they're doing is essentially printing money to fill in that gap, that income gap that I talked about. Now, what this could relate to, what this could translate into, and I think a lot of people are concerned about this, which is why you're seeing the huge spike in silver, the huge spike in gold, is inflation, naturally. But another step to that is what is called as store hold value, right? Or the ability to, if I put a dollar into something, how I can maintain that dollar's value in the future. So the ability to store hold that value. And what's happening is because they're printing so much money, the risk of not having that store hold value goes up and up and up and up with every dollar they print. What does this mean? Okay, well, if you're an investor and you have all this cash in the bank, you're just waiting to use it, that is probably the worst scenario to do. Again, this is my opinion, but I believe that having cash in the bank, just sitting aside, waiting for whatever, doom and gloom, is a terrible strategy. You're exposing yourself to the possibility that the dollar inflates, right, or has an impact from inflation, and quite drastically, right? So, and if in doing so, if you have let's say $250,000 in the bank, and inflation goes up to 5-6%, you can see how you're going to be losing $10,000, $15,000, $20,000 of that capital in your bank just sitting there. So what you got to be doing is thinking about, okay, well, where can I deploy the capital? And in doing so, you'll get a return to offset the inflation, right? And this goes back to what he was talking about and what I think is right on the money. Deploy the capital, but do it in a way that's diversified to reduce your risk. Putting it all in the market is a terrible idea. Putting it all in real estate is a terrible idea. Putting it all in the private money lending is a terrible idea, or whatever you're putting it in. It's got to be spread across different asset classes, different asset types within those classes, and just, across the board. So I'm with him 100%. And this goes back to, again, my belief that the 1/3, 1/3, 1/3 methodology is a good starting point. Definitely not the solution for everything, but that's what I use. Again, and that formula is I put 1/3 in the market. Now within the market, I use the all-weather portfolio, and then I have a small 20% of my portfolio for speculation as well. I have 1/3 of my capital going into hard assets, whether that be real estate rentals, whether that be syndications, whether that be, you name it, hard assets in real estate that produces cash flow. Then I have 1/3 of my money in arguably my favorite asset right now or investment type, which is private money lending. And that's providing me right now around 14 to 16% annualized returns. And so that's how I'm doing my portfolio. Each person will have their own technique, and you should too. But it's, my point is my cash is not in the bank. My cash is out in some sort of investment, earning the interest so that I don't face the risk of the inflation or the loss of store hold value. So I want to say that, and I want to hit on something else, right? What does this all mean, right? Or like, as it relates to real estate, what does the loss of store hold value mean, or the risk of high inflation mean? And what's pretty amazing is that real estate is going to benefit substantially from this. And this is why I've been, on forums been saying, and there's probably a few other investment types, but for sure, real estate is going to be one of the top asset classes that outperforms most other asset classes, at least for 5 years. The reason is twofold, really threefold. Cost of debt. Right now, the cost of acquiring a 30-year mortgage is at all-time lows, right? 2.8, 3%, very commonly heard of, right? You're getting loans for essentially the rate of inflation, historical inflation. That is just unreal, right? And it's fixed. It's fixed debt, meaning it's not going to be variable in the future. So there's that piece. Inflation, right? Well, we know that there's a massive shortage in homes right now, okay? And there might be an influx of supply in the lower end markets if the foreclosures happen, that they're in that lower end CD class arena. But for the A and B class homes, massive shortage. For the entry level, millennial buyer that's trying to start a family, massive shortage. And so you have the supply side problem on your side for appreciation of the asset value. But additionally, inflation is probably going to be driving up those asset classes as well. So you put your money in real estate, arguably the store hold value of real estate might or should equal close to the inflation rate. And then additionally, because you have fixed debt on a fixed amount of income, $100,000 loan today is not going to be worth $100,000 in 10 years, right? So that inflation rate, or the risk of higher inflation, the risk of having a lower storehold value across assets, will essentially make your loan be worth less in the future. All the while you're paying on it at substantially lower than average cost of debt. So it's a really attractive asset in a number of ways. And if you're really savvy, you're buying, rental properties that cash flow. In the market, you're probably looking at 7 to 10% cash on cash ROI these days. Nothing sexy, but when you factor it all in together, it's going to be a substantial asset to have in your portfolio for sure. And so I think that's partly why too you're seeing a massive wave of investors hit the market among another wave of reasons. But there's a huge influx right now of demand towards these rentals, and again, it's hard to even find deals. We're out there trying to find deals for our clients, and there's not very many that make sense. And so people get the words out. People want to get in this game. They want to start investing, and you're probably too late in a lot of markets, but we are still finding some deals here and there. I'll tell you, when we do find a deal, they sell in 1 to 3 days, like quick. They list, usually have an offer on it within 48 hours. So it's interesting times, because I think if you know what you're doing, I think if you have a plan in place and you know exactly what you're looking for, there's still opportunities out there. If you're, getting your toes wet, just trying to understand what's going on, and maybe you'll get a deal or two, I don't think you'll be getting a deal or two. I think you'll be waiting on the sidelines until you're ready to take action and move fast. So long story short, I think that we all can agree that assets will produce lower returns over time due to the inflation. And what that means is, if you ordinarily get 10% on your investment with an inflation rate of 2%, then essentially your effective return or real return is 8%. Well, if inflation goes to 4 or 5%, yet you're still getting 10% returns, your real rate of return goes down to 5, maybe 6%. So across the board, asset classes will net have a lower return for investors, but I think it's more about how you're playing, where you're putting your capital to store the value. And I think when you look at gold, silver, real estate, those are attractive options. So I'll stop there. Again, this was more about the idea of how the inflation will affect your portfolio, how the risk of storehold value is substantial. And so be careful. And if you have a lot of cash in your bank, do consider deploying that in ways that are safe, and that hedge against the risk by using diversification in your strategy. Questions, you can always email me. I'm happy to answer, or give some tips on techniques that I'm doing, or schedule a call with me. We can do a more thorough deep dive on your strategy. And really big lineup of guests coming up here. I just got confirmation that we're gonna have a Navy SEAL from the elite Navy SEAL Team 6, which is the elite of the elite. He's gonna be on here talking about personal mindset and how you can develop mindset for success, from what he has learned in all his 20 years plus as being a Navy SEAL. So really big stuff coming up here. A lot of good authors too, and all kind of fund managers. We have a big lineup coming up here in the next month or two. So looking forward to that, and seeing you there. Thanks, everyone.